What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is January 10th of 2024. Well, folks, I hope you all are having a fantastic day wherever you are, because today we've got a jam-packed episode, but I gotta start with a bit of a rant and rave. As you all have likely heard to some degree, there was a fake or unapproved tweet out of the SEC's Twitter page stating that a Bitcoin ETF or all the applications for Bitcoin ETFs had been approved. I'm going to go ahead and talk about one of the most critical issues that I unfortunately feel practically no one is talking about that needs to be said. And outside that, we'll talk about the price ramifications, if this changes anything for Bitcoin. And beyond that, we're going to talk about altcoins, some of our setups that we're watching that you guys can also follow as well. And beyond that, we've got to talk about one of the most important charts in equity markets that could signal a major and significant correction coming forward. We got a lot to unpack here in today's video, so if you happen to enjoy it, consider dropping a like. It's one of the greatest ways you can support the channel. And beyond that as well, if you guys happen to miss it, I forgot to put the link in one of the prior videos. We are looking for new video creators here on the DataDash channels. We hope to expand and get more faces and quality people conducting research, producing content here on the channel. So if that interests you, then definitely give it a shot. Check out the link down below in the description. It's relatively easy to apply, and if you don't have the best camera or microphone, don't worry about it. Just go ahead and give it a try. I care much more about the substance and the content. So let's go ahead and talk a little bit here about this fake tweet that came out from the Securities and Exchange Commission official page on X or Twitter, whatever you want to call it. Generally speaking, this has been the big topic here. It got, I think easily 20 or 30,000 likes. I saw it about 5 minutes after it got tweeted on the page. And this, for a lot of people, was an official confirmation that an ETF had been approved. It had a printed out photo here. It looks very similar to most of the SEC tweets. It was very convincing. And I had a quote here from Gary saying, "Today's approval enhances market transparency and provides investors with efficient access to digital investments within a regulated framework," yada, yada, yada. So generally speaking, you have this tweet coming out from the SEC, and everyone in the woodworks. I'm talking, I wouldn't want to name names here, but hundreds of major crypto influencers and even mainstream media outlets, because they want to rush to being the first to the news and get engagement and not take the time to actually verify things, shared this blindly on Twitter, Telegram, anywhere you can name. And within around an hour, 2 hours, it was clear that this was fake. Now, let's go ahead and understand how this even happened in the first place. The issue supposedly was the fact that the SEC was not using a two-factor device on their account. I agree as much as the next person that the Securities Exchange Commission not using some form of authenticator application, let alone even if they had a mobile number as their two-factor, as a government agency that needs to have protective control over what gets published on its Twitter because its words can move markets. That alone is an absolute sham. It's absolute disgrace. And to not have an operational security team at the SEC that even understands the basic security benefits of two-factor authentication, pretty much the necessity at this point, beyond me. That being said, while I understand that all those people who share the news would love to tell you that this is the SEC's fault, it's not. It's not entirely the SEC. We as investors, and beyond that as well as content creators, need to have a healthy degree of skepticism, including mainstream media outlets, on reporting news. Making sure that we're not utilizing our ability to spread news as quick as possible, potential fake news, in order to get informed engagement. No, I think at the end of the day, it is important in the 21st century, guys, and this is just only going to get worse with AI and deepfakes. You need to wait until you get a proper confirmation of things. Because I'll be honest with you guys, while there might be an investigation to this, if you were trading on leverage during this period of time, if you were short or long as things went into the opposite direction, and you get knocked down on your trade, SEC isn't going to compensate you. 99% chance you are going to get wrecked on your trade, and no one is going to be there to save you. And I'm only saying this now, not because I felt that you guys reacted to or anything like that, but I saw a lot of people who got sidetracked by it. and then afterwards are trying to justify, oh, but maybe it was a premature tweet that was basically published on the wrong day. There were so many people again who had reported it early, off of this one tweet, and then tried to backtrack and justify why they did it. Look, I'm not here to give everyone like a huge amount of crap and stuff. It looked pretty official, and yes, the SEC made a huge mistake here, but I think there was an equitable mistake in people who were quick to report the news. And in our alerts group and practically anywhere where I communicate with you guys, I did not rush out to do a live stream. I didn't rush out to send an alert because it wasn't confirmed. You've got to understand that, guys. We've had Twitter hacks like this before. This has happened on huge accounts in various fashions on what many people see as, again, this social platform for the news or what's going on in markets, right? You still have to maintain that degree of skepticism, because if you don't, the market will take advantage of that. This has been wholly confirmed now by both the SEC. And again, as I mentioned, and it's been updated, of course, but last night CNBC had a breaking tweet that the Bitcoin ETF had been approved. Even mainstream media outlets don't have the kind of inside sources, the industry experts, to let you know whether or not these things are true or not. So again, I want to talk a little bit about what this means for price. One thing that's really interesting is what we've been talking about for the past couple of weeks. While of course, yes, we said in the near term there'll be a short-term wave of increased volatility. One thing I mentioned is that I really don't think that post this ETF announcement, which we kind of got to see it in price action now, leading up to the supposed January 10th deadline, I think what we saw is exactly what we discussed for the past few weeks, which is if you take a look at price action, not too much has changed here, right? We're not too far off from where we were back here in early December. Bitcoin has had a relatively neutral month. It has been trying to establish these higher lows and higher highs, but whether or not it's going to be able to continue to do that, that's another question. The main thing I tell you guys right now is that yes, we're above the 21-day. Price is still holding confident above that trend. And as we've talked about, so long as it does that, Bitcoin is bullish right now in the near term. I'm not saying that it's set up for a new bull market or anything. I'm just saying in the near term, it's holding above those 21-day moving averages as it has been doing since back here in October. Nothing wrong there. However, we are getting up into resistance territory, in my opinion. Not only the ascending channel, right, which would get us topping out somewhere here around probably a little bit higher now and stuff around maybe 55,000 if things really start to move parabolic. But main resistance here that you have to be aware of is the resistance mark here in March of 2022. And generally speaking, the resistance band from that similar price range of 48K up to 52K with some of the mini resistance points and prior support ranges we had in the past, which could start to act as resistance. So that's kind of the range where we'd already kind of expect Bitcoin to top out into this news. People are saying that this fake tweet might lead to an investigation and a delay in the ETFs and give the SEC an excuse. I don't know if any of that's true, guys. I'm not a legal expert. Those people out there who are giving you their opinion are probably giving you as better of a guess as I could or anyone else, all right? My main point here is all you got to do is watch those moving averages. Watch how price reacts with the key bullish momentum indicators that we've discussed here in this channel. And beyond that as well, we got to track how other plays in the market are performing as well, as it does send a gauge for sentiment. One negative sign we're seeing here is Total 3. The broader altcoin market is not looking too good right now. It's looking like, as we've discussed for the past couple weeks, that this needs to cool down, that we need to see this probably pull back into the later part of January, or at least the mid part of January. We've already seen total altcoin market cap correct around at a minimum $45 billion here from the relative peak. And we can see that the 21-day, which was serving as clear support, it's clear that this is starting to play out as resistance here for price. And again, while we've been utilizing as a fair argument the 21-day as a means of support, when it starts acting as resistance, that's your sign to take advantage of any rallies in altcoins here in the near term until that starts to change. And instead, look for entries at healthier moving averages like the 100-day moving average, which is very close here to the 200-week. And I think, generally speaking, as it's rising up here over time, getting an entry here when altcoins are below $440 billion, which is probably where the moving averages will be during that correction, I think that's a very fair entry point here for some really strong plays in the market. Some of the ones we've been discussing here. Plays, for example, like Stacks, which while it is definitely up here at $2, we talked about it when it was around 60 cents. It's been on a great run here, but we're probably going to see some of the exhaustion from this ETF anticipated rally start to play out on Bitcoin related narrative plays. You don't want to get caught FOMOing it at the top. That's why, again, I'm watching how price reacts here with the 21-day. And also the Lux Algo support band here on the Lux Algo signals and overlays indicator, one of the few tools that we also utilize for finding entry points. This has been green since back here in October, very similar to Bitcoin. If this starts to break, I'm looking here at the 100-day moving average, which again might give us an entry here around $1, nice 50% pullback. I'm not saying it's guaranteed to happen. Stacks is a pretty strong play here, but again, even if it holds up here, we'd also consider an entry here within the green band. But I think there's a good chance here that you're going to get a pullback somewhere between that gap at the 21-day and the support band. Take a look at ordinals as well. Ordinals looks really heavy here, guys. No price anticipation or appreciation since back here on Christmas. And you can see that that 21-day, the momentum is stalling. It's flatlining here. And price is barely budging off of it when it comes down there. That's not a good sign to see. And once more, we can see our Lux Algo signals and overlay indicators starting to rotate downward. Right? We've seen this before, but just keep in mind here that if we get down there and it doesn't hold confidently on a near 50% pullback down to the $50 range, then that can be a sign to exercise caution on some of these ordinal plays. These are a little less fundamentally sound or valuable, more speculative than something like Stacks. I want to talk about meme coins. A lot of people saw the move on Bonk here. We had 2 straight days of around 17% moves, and now we've seen basically about a 7% up move here today, but struggling when we face that 21-day EMA, not to mention Lux Algo daily support band here again since October was green, but flipped here in early January. This can be your sign that we need to expect prices to move lower here. Now, if we get back above that 21-day, we clear through the Lux Algo support band, this may be able to just really continue ripping higher. I don't think the odds are favorable here. I think we need to set ourselves a little bit more conservative here, expecting that this will probably pull back into the 100-day pocket, and we need to see it hold there for some time to really establish a foundation to continue moving higher. That's at least what I would say from a technical analysis perspective. But again, we will continue to watch and see how it reacts to this. Another one that I think you guys need to keep on your radar, much smaller market cap here, so it has the ability to have multiple returns here, considering especially as well that some of the optimism from Sol has recirculated back to Ethereum over the past couple of weeks. I definitely recommend watching Bob USDT. Again, I know it's a meme coin, it's silly. Should this be what we're discussing? No. Is it the trend in the market? Is it where people are going to, because there aren't many fundamental advancements in the crypto space in new DeFi use cases and really compelling things around real world assets and all these things? Are there some innovations? Of course, but is there much that's really capturing the market's attention enough to really build up a new narrative? No. I would say that it's mainly meme coins. And I would just say if you just ask the broader market about what they're watching, they would tell you Bonk and other related meme coins that have made multiples. It's unfortunate, but generally speaking, we can see that Bob, with a further pullback here, might be coming into the perfect scenario here, testing the 200-day along with the 100-day pocket, and outside of that as well, coming towards a very significant prior support line to see if this time around this can become a new foundation of support for this to leapfrog higher. I think that Bob is definitely one to watch here just because of the technical setup and considering the strong amount of holders it has, considering the nice healthy pullback that we have a potential entry getting into. I'm going to continue to watch this one. And I would say if it breaks above the 21-day here as well, I probably wouldn't sit around and consider that that might be a good entrance as well, as this one already has a couple multiples to get back up here towards its prior highs and could potentially be breaking out to new highs as well, really continuing to climb higher. So that's a potential play that I'm watching. But as you guys have probably seen on a lot of these plays, we're watching to see how it reacts with Lux Algo, which is one of our key momentum indicators. Now, Lux Algo is a suite of indicator tools that you can subscribe to, and you can get access towards a whole range of really interesting insights. I personally like to use the signals and overlay tool. It's the most powerful one for me. It's their main indicator, and I use their trailing band of support and resistance, depending on how the trend plays out, in order to help me gauge when there are trend shifts in markets, as well as when there are potentially good risk reward setups to get into. If you guys just want to try it for a month, if you want to try it for a quarter or for a year, you guys can sign up using the link down below in the description, and any kind of discounts that will be available will be automatically applied towards your link. But I definitely recommend you guys check it out, give the platform a shot, and if you don't like it, there's a 30-day risk-free period where you guys can get your money back. So definitely consider checking that out. All right, last but not least here, we talked about Bitcoin, we talked about altcoins. I want to talk about equities here because beyond all the topics we discussed today, I think this honestly might be the most important one. I know many people think that I'm a little bit too macro sometimes, but I want you guys to understand that the macro ramifications of what we're going to be discussing today have huge weight not just on the broader performance of stocks, but all assets as a whole. People like to believe that Bitcoin, just because it's still the top performing asset versus the indices, that it doesn't have a correlation to the performance of equities. If you simply just take a look, I know many of you know this already, but I just want to echo this again. You guys can, on TradingView, basically take any given chart. You take the S&P 500 and you can come up here to the plus icon, which is the compare add symbol, and simply add in on another price scale Bitcoin's chart or any other type of asset you'd like to add, and you can see the alignment in their performance. So this is imperative to keep a focus on here when we're conducting our analysis. And the chart I'm going to share you here today is something that I would say easily 98% of investors have never seen. They don't watch these things, and it is a custom ratio of the performance of Apple versus the S&P 500. Now, a lot of people might hear about plays that outpace or underperform the S&P 500. That's a goal of many traders, but many don't take the time to actually analyze ratios. And what ratios can tell us can be incredibly powerful. What we're taking a look at is Apple's stock symbol divided by the S&P 500. And what I want to indicate here today is the potential chance for a significant correction in Apple versus the S&P 500. Now, so far, I'm not going to be all doom and gloom here. It's been about a 12% pullback, and we've seen this before in the past. We saw this, for example, back here in 2020. We saw a similar correction during that period of time of around 24%. But the main thing I want to talk about is looking back towards history where we've had 30% or upwards of 40 to 50% corrections in Apple's performance versus the S&P 500. Now, why do I highlight these pullbacks here? The reason I highlight them is because Apple has been the market leader for the last decade. It is consistently, over the long term, outpaced the broader S&P 500. Really, since back here during the dot-com era, Apple has outperformed the S&P 500 by 22,250%, and it has been a market leader over the last 2 decades because of this. But Apple is a near $3 trillion company now. Apple is a company, in many people's eyes, I think a growing number, we've been speaking about this for the last 2 years, Apple is becoming a dinosaur company. It's not to say that Apple isn't a titan. It is obviously tapped into every market it can. And yes, maybe it will continue to find some new smaller markets that it can get into. But the iPhone and beyond has been a pinnacle and pivotal moment for this company that's been around for a few decades. And it has milked the majority of it out over these last few years, becoming one of the most profitable companies in the world. That being said, markets care about growth. And if we're not seeing growth, potential upside from here on out in Apple's revenue and income beyond where it's at now, it's a stagnant company in our eyes and in the market's eyes over time. And at a minimum, even if you believe that Apple's going to come back and continue being more relevant, it is historically proven here that after every couple of years, we are well overdue for a 40% pullback here according to history. During these periods of time, Apple starts to cool down, and when Apple cools down, it starts to weigh the broader asset markets down. Because while some of that value may circulate into other plays, a lot of it is people cashing out and taking that capital out of equity markets, lowering the premium on asset prices. And if you don't believe me, just take a look at any of these pullbacks, October 2018, April 2015 here to April 2016, October 2012 and April 2013, and here in 2008. You can go back and see these were not optimistic periods of time. Now, for example, you have 2008, which is a little bit self-explanatory during the recession, but beyond that, If you take a look at some of these kind of corrections during these periods of time where we weren't per se in an official bear market or like a 30% pullback, you at least had a 15-20% across the board correction in equities. Because Apple being such a large company and having such a large concentration, its moves, when it makes moves in prices, it affects the broader equity markets and assets as a whole. When a $3 trillion asset, one of the most valuable companies in the world, is pulling back, 20-30% against the S&P 500, it's going to have a weighted effect on the perspective of valuations across the board. And we've seen that throughout history. We can go back and look at the S&P 500 and you will see that. And the reason I want to signify this is important is not only that it would be normal to expect that we're going to see a 15-20% correction here while a lot of people are screaming soft landing, recession averted, everything's all good. Inflation is still sticky. The economy is not looking great. We look like we're still in stagflation, the sign before a recession. But beyond that, even if you don't agree with me on that, take a look here at the quarterly Lux Algo support band, right? On the signal overlays indicator. Right? A mere 30% correction has already got us testing the support band, which we haven't tested in a long time since back in 2013. But if you get a 40% correction, that will be the first time that the quarterly, right, the 3-month quarterly Lux Algo indicator has flipped red. The last time we were red was back here in 1999. This would be unprecedented for the trend here, and I think could signal that we are going in for a long-term shift from large cap tech plays, especially those not tied to the hot new narratives of AI, right, into the smaller mid caps as the market looks for new leadership. And that, in my opinion, is one of the clear signs that we're not ready for a new bull market. Bull markets, historically speaking, require new leadership. Unless the prior leaders are going to continue to show up to the plate, doubling and tripling their revenue over the next 10 years, adjusted for inflation, that is. Apple's not really an exciting company. Take a look at its financials for the past few years, guys. It's definitely a cash-rich company. Doesn't mean that it can continue going up. Doesn't mean that it'll always remain as relevant as it is. And even if it has stock buybacks, even if it has all these great things that help prop up the price, investors will start to reprice companies like Apple that they're trading at a 30 PE multiple to something more reasonable, like a 20 or 15 PE multiple, as it has been throughout a lot of its history over the last decade. And when that happens, a 50% correction is easily in the cards. Not to mention, if it starts to see declines in its revenue, maybe due to tensions in China, maybe due to the fact that, depending solely on the iPhone may not be Apple's best bet. And of course, there are other products. There's the AirPods, there's iPads, there's MacBooks. Sure, Apple's a very well-diversified company, but it's got some weak links. And if it starts to showcase those and can't show up to the plate, this isn't me criticizing Apple per se, but just the cycle of any given company. IBM used to be one of the largest companies in the world. Now it's a deadweight company, right? I could go on. ExxonMobil used to be one of the largest companies. Cisco Systems used to be one of the largest companies during the dot-com bubble. Where are they today? They eventually stall out. Expectations get ahead of themselves, and things start to slow down. I say this here as well because on the monthly time frame, Lux Algo is giving us this kind of support range, this resistance range here. I would wait at a minimum to see us clear through here and get well above these prior relative highs back in January 2022 before calling it quits on the bear market narrative. Because if we face resistance here and we start to cycle back down, we've got a very critical range here that could provide a generational buying opportunity. I'm not saying it has to go all the way down here, but with a snap of the 200 week, you guys can see this kind of stuff can happen. 57% pullback in 2008. Dot-com bubble saw 50% correction in the S&P 500. Not crazy to think that we could see something in this ballpark a little more powerful and impactful, especially if we have a rotation towards cryptocurrencies or some other type of market, or especially a big rotation from the large cap stocks in the S&P 500 to the small caps. Maybe the Russell doesn't fare so badly. And maybe it doesn't come all the way down here. I'm not here to say that it has to happen overnight. I have to say there's not anything in the economy that I think is as bad as 2008. And yes, tech stocks are not as overbought as they were in the dot-com bubble versus their earnings. But with the PE multiple contraction, you can already get a large amount of the way there, even without some significant thing breaking the economy, just having a typical earnings recession. And maybe more conservatively, you get somewhere here in the mid-range between the chop we saw during this period of time. Maybe we don't come all the way back down here. And I get people's skepticism of that. I'm just saying to be prepared for something like that to happen. Rather than thinking about the sky is the limit, this thing's just going to charge forward, and AI is just going to change the world. AI is cool. Generative AI is definitely an interesting technology, but it's got to make up for the lacking growth in smartphones and social media and all the technologies that helped build up the valuation increase over the last decade of 574% from those lows. We got to be a bit cautious on that. We've seen historically that after an extended period of time, we can have significant pullbacks. So anyways, guys, don't mean to be too bearish here, just letting you guys know, and at least the near term, even if you disagree with the recession topic, expect a cool down in equities, right? It's been a great run up here in 2023, but this has mainly come off of not exceeding growth, but basically spending cuts and other things that, again, are signs of, an indicative sign markets are overextended here and don't have any fundamentally exciting narratives. So if you guys enjoyed this video, consider dropping a like, and outside of that as well, I wanted to let you guys know that if you guys are looking to invest in crypto, one of the biggest things you need to be made aware of is not so much just getting the best altcoin or getting it at the right price, but if you guys are looking at altcoins or Bitcoin, you need to understand that if you're in the United States, making sure your tax strategy is at play is one of the best things you can do to maximize your returns in the long run. That's why an individual retirement account or IRA is one of the best structures that you guys can consider setting up. Again, I recommend you guys talk to a financial advisor or a tax accountant. But an IRA will generally allow you to set up a retirement account, an investment account that allows you to invest in crypto. And you don't have to pay taxes on it every given year. You'll only pay taxes on it when you close out the account into your year's retirement, and you'll pay it at an income bracket that you'd be earning at that time. So you're likely to be retired or not earning any income, so you pay a much lower tax rate. So it's a really cool thing. And you can, again, roll over your 401k, your TSP, your 403b, 457, and many more different types of accounts using iTrust Capital, our long-term partner on this channel. So check out the link down below in the description if you guys want to give that a shot. But that's it for today's video. Thank you all so much for watching, and I'll see you guys in the next video on Friday at 6 a.m. Eastern Standard Time. Take care, everyone.